I don't mind my own financial life to be a portfolio play, knowing that some deals will do well, some deals will do poorly. Most will make money on, but some will lose money on. Maybe some will lose a lot of money on. I'm an angel investor. I invest in businesses. So I'm used to losing 100% of my money on 70% of my deals, knowing that I'm going to make a lot more on the other 30% of the deals. That's me personally.
Tim is one of the most authentic and genuine people I've ever met.
Sincerely believe he's coming from a position of giving, and that means a lot.
You're going to make huge progress.
Welcome, everyone, to today's Hero Capital Raising Party. My name is Tim Mai, and today we have an awesome guest on the line with us. He's very popular, and when in this promotion, there were so many people that wanted to hear and learn from Jay. Jay Scott is an entrepreneur, investor, author, and a partner at Bar Down Investments, focused on buying and repositioning large multifamily properties. In the last 14 years, Jay has bought, built, rehabbed, sold, lent on, and held over $160 million worth of properties around the country. Jay holds a strategic advisor roles in several companies and is the author of the bigger pocket books on real estate investing, including the best-selling The Book on Flipping Houses. And Jay has personally raised over $40 million. And so super excited to interview him today. Jay, welcome.
Thanks, Tim. That was a great intro. I appreciate that. Thank you, everybody, for being here. I'm really excited to get to chat with each of you.
Yeah, we're definitely excited to hear about you and your story. So if we can start with that, share with us, how did you get into this real estate space? And also, what got you into the multifamily side of the real estate?
Yeah, so I knew nothing about real estate until 2008, until I was 37 years old. Went to school, became an engineer, moved out to California, worked in Silicon Valley for some really big tech companies, got my MBA, did the business thing. And then 2006-ish, I met my later-to-be wife, and we decided to get married in 2007. And when we decided to get married, we both realized that we were working like ridiculous hours, 60 hours a week. She was traveling 3.5 weeks a month for her job. I was traveling a couple of weeks a month for my job. And we knew it just wasn't the lifestyle we wanted when we were getting ready to start a family. And like I said, at the time I was in my mid 30s, she was in her mid 30s. We knew that if we're going to have kids, we were going to have to do it pretty quickly. And we just didn't want to have a family where we never saw the kids and we have nannies and we didn't get to go to their soccer games or their piano recitals. I just didn't want that. My wife and I, back in 2008, decided, let's quit our jobs. Let's start something on our own. We didn't know what that something was. We moved from California back to the East Coast. And in summer of 2008, we accidentally flipped a house. My wife was watching HGTV and said, that looks like fun. Let's do that while we're trying to figure out what business it is we want to start. And so we flipped a house and a second house and a 10th house and a 50th house. And before we knew it, we had flipped a few hundred houses and we figured out, I guess we're in real estate now. And that's how the real estate thing started.
I love that. That's amazing. And then what got you into this whole syndication multifamily space?
Yeah. So 2018 rolls around. We've been doing single family flips for 10 years and I was ready to tear my hair out. I was burned out. I was tired. I was stressed. I enjoyed the business side of real estate. I've never been a nuts and bolts real estate guy. I don't swing a hammer. I don't like managing contractors. I don't like even seeing the houses that we work on. I'm a business guy. And so I was able to grow my real estate business, or my wife and I were able to grow a real estate business because we were good business people and we focused on systems and processes and hiring and scaling, all of those things that you do in a good business. And what I found was certainly you can do that in single family residential to an extent, but it's a very difficult business to scale because it quickly becomes unwieldy. And it can be very difficult to find deal flow without expanding in different markets and a whole bunch of reasons why single family is a really tough business to scale. And so 2018, I decided I'm done. I'm done with real estate. I'm done with single family. I was just that burned out. I was going to go back and do some advisory work or sit on some boards for some tech companies or something else that didn't involve real estate. And what I realized was after I stopped flipping houses, I had all this cash coming back to me. And I said, okay, what am I going to do with all this cash? And that's when it hit me. Oh, real estate. That's the right place to be putting my cash because it's something I know, it's something that has great tax benefits. And so at that point, I had to start thinking about who am I going to invest all this cash with? And I realized I don't trust anybody. I didn't know anybody that was doing syndications at the time. I didn't know anybody that was looking for passive investors. I didn't know that side of the world. And I didn't just want to hand my cash over to somebody I didn't know well or somebody I didn't trust. And so I said, okay, I'm going to start doing bigger deals just to have a place to put my cash. It's not going to be my full-time gig. I'm just going to buy some big stuff so I have a place to put my cash. And so I reached out to a friend of mine, Ashley Wilson, who was doing large multifamily deals. And I said, I've got a bunch of cash. I could put it with you, but I'd really like to do my own deals. Will you teach me this business? And I said, I'll take the next year of my life. I'm not doing anything else. I will come work for you, volunteer my time, give you anything you need. You'll have access to my cash, my Rolodex, my knowledge, my skills, my time, my effort, whatever you need. And in return, all I ask is that you teach me the business. And she said, absolutely, let's do it. So 2019, I worked for Ashley for a year. She was doing multifamily syndication. Realized that she and I had a tremendous rapport. We had very complementary skills. All the stuff I was good at, she wasn't. All the stuff she was good at, I wasn't. And in 2019, she said, partner with me. Let's do this together. And I said, okay, let's do it. And so since 2019, Ashley and I have run Bar Down Investments together, and I've been a multifamily syndicator.
That's awesome. I love that. I love that approach to getting educated in an industry that that you're new in. And yeah, a lot of people think that, hey, I have to either learn this myself or I have to spend a lot of money on coaching. But a lot of people don't think about, hey, I can just intern with someone, right?
Absolutely.
Or I can just go work with someone. It's an amazing way to learn for sure.
Everybody has skills, everybody has knowledge, everybody has value that they can provide to somebody else. And so Ashley knew that even though I didn't know the multifamily space, there are plenty of things I could do. And so from her perspective, if she could take advantage of my value, I could take advantage of her value. It was a win.
I love that. I love that. So since then, since 2018 or 2019 is your official partnership, since 2019, how many properties have you guys acquired since then?
She had a few coming in when I joined her, but since 2019, we're a relatively small shop. We invest a lot of our own cash in our own deals. So we're pretty conservative. So we have bought 5 deals since 2019. So we average about 1 a year, maybe 2 in some years, 0 in some years. So we're not doing tremendous volume, but they're typically pretty big deals between 20 and 40 million.
I see. Very cool. Yeah. And that's what I love about this business is so many ways you can skin this cat, right? You can do smaller deals and own the whole thing yourself. You can do a bigger deal. And what Jay was saying, bringing a lot of his own cash into the deal. In my case, I chose to go another direction, which is I'm in a lot of deals and I raise capital for them. And I just have a smaller ownership in many deals. And so, yeah, there's all different ways that you can do this business. So share with us, I know you've been doing this for a long time and you've raised money, you've been a private lender, lend money, now syndications as well. What have you found to be the differences in the way that you raise capital, whether it's for fix and flip deals or for the syndication deals that you are doing now?
It's basically the same. So raising money from people is, and this is the cliche in the business, you need people to know and trust you. And that takes time. And so as capital raisers, all of us, what we need to be doing every day we wake up, whether we want to raise money for a deal today, tomorrow, or 10 years from now, every day we wake up, we need to be spending our time and our effort building credibility, building our reputations, and making sure that our reputations stay pristine. Because at the end of the day, I've been doing this for 15 years. My name's out there a whole lot. I'm proud to say that I don't think you could do a Google search and find anything negative about me. And that's by design. I've worked really hard over 15 years to build a reputation that's beyond reproach. And I probably couldn't raise as much money as some people, but my investors are tremendously loyal and tremendously trustworthy or trusting in me and are very happy to invest with us because they've gotten to know me in some way, shape, or form over the last 15 years. And for me, it's just every day you wake up and you think, how can I preserve my reputation today and extend it and continue to build my reputation build credibility, and most importantly, how can I continue to add value? Because a lot of raising money is reciprocity. People invest with you because not only do they know and trust you, but in a lot of cases, they feel like they owe you or they want to owe you. And so I spent a lot of the last 15 years trying to add value to people's lives, whether it's through my writing or my podcasts or my newsletter or speaking or just going and mentoring and helping people. There's a lot of people out there that I think invest with me simply because, wow, Jay's been giving me all this value for the last 10 years. I'm happy to give back.
I love that. Yeah. And I love what you said about focusing on the quality of the relationship, right? Focusing on adding a lot of value, because we all know there are people out there that are very popular, but yeah, you also read on their reviews and they have very mixed reviews, right? Some people love them and some people just hate them. So everybody has their own their own way of building their audience, and whether they want to play the polarizing route, or in your case, like, hey, I just want to give a lot of value, give a lot of love to the community, and build my reputation that way. I love that. I know you're a big contributor with Bigger Podcasts. How did you get into that war of it?
Yeah. So 2008, when I was getting ready to flip my first house, I went on the internet and I did a search for how do I flip a house, just like most of us do. And what came up back then, before there was as much information out there as there is now, was Bigger Pockets. It was kind of the only place to go. It was still pretty small, a few thousand people, maybe 10,000 at most. And so I started contributing there and asking questions and providing any information I could on the things I knew. Again, I knew the business side. I knew how to scale and put in place processes. And so while I didn't know anything about real estate, I think I still tried to add value. And it was at that point a pretty small and tight-knit community. A lot of us got to know each other. And Joshua Dorkin, who was the founder of Bigger Pockets, used to contribute like daily as well. He'd literally sit in his basement for 12 hours a day and answer forum posts. And so I got to know him. And in 2010, I actually consulted with him and helped him on the tech side of the business and help him a little bit grow the business and make some decisions. So we became friends. And in 2013, I decided to write a couple books, and I reached out to Josh and I said, hey, do you want to publish these through Bigger Pockets? And he was like, oh, I don't know. Do I? And I was like, yeah, go for it. I'll take care of everything. You just send out a message saying, hey, we have these books available now if anybody wants to buy them, and I'll fulfill the orders. And that's how Bigger Pockets publishing got started. And that kind of solidified my relationship with Josh. And then Josh sold the business in 2017. I ended up running the business podcast that they did for a couple of years with my wife, and I'm still an advisor for the company. So yeah, I've had a great relationship with them over 15 years, and it's been tremendous.
That's amazing. I didn't even know you go that far back with them.
Yep.
But what's really key about what you shared is that you went on and participating in the community and contributing to the community, adding value to the community very early on in your career. It wasn't like, hey, yeah, now that I need to raise money, I'm going to start like building my community. It's like you built this thing way before you needed anything from the community. I love that. And I'm sure you probably didn't set out this way, but the way that you, because of where your heart is in providing value to the community, you're automatically positioning yourself as an authority. And then you writing the books, being the author, being the coach, the mentor. I'm sure that has played a huge role in the businesses that you've been able to attract and the investors that you've been able to attract to your business as well, correct?
Yeah, but here's a tip for anybody out there, because a lot of people look at me and say, yeah, it's easy. You've been doing this for 15 years, so it's real easy for you to go out and talk about all the stuff that you're an expert in when you've been doing for a long time. But what a lot of people don't realize, and I think this is a really important point, when I started in 2008, before I ever bought my first house, and you can go back and you can look at my blog posts up until like for the first 8 or 9 months before I bought the first house, I started a website, a blog called 123 Flip. And my goal for that website was basically to hold myself accountable. And I literally every day I would post, here's the first piece of the business plan I was writing. And I'm going out and I'm talking to wholesalers looking for a deal. And I'm learning this, I'm learning that. And as I started buying houses, every day I would post information about the houses. I'd post videos and pictures of the renovations. And I would post all the costs down to the penny, what I was spending to buy and rehab and sell all of these properties. And whether I lost money or I made money, I didn't care. My goal was basically to document the process from start to finish. And still, if you go to that website, I haven't touched it in close to a decade, but you can see the first 50 flips that I did in gory detail. And I still have people that come to me today and say, hey, the reason I'm investing with you or want to talk to you about investing with you is because I got my start by reading 123flip.com 10 years ago or 12 years ago or 15 years ago. And so for anybody out there that thinks you can't start building credibility, building a reputation, building a brand because you're not an expert yet, that's ridiculous. Go just put your name out there. And again, add value in whatever way you can. For me, it was adding value by just sharing my journey. And so you'll find that, again, in a year or 2 or 5, any efforts you put in now to add value to other people's lives, it'll come back to you.
I love that. And like this very show right here is a testament to what you just shared there. I started in this syndication space a year and a half ago. And I knew I wanted to focus on and get good with capital raising. So the first thing I did was start a Facebook group on capital raising, and then started this weekly virtual meetup here and interview a top capital raiser, top syndicator in our industry. And yeah, so you guys are definitely like a part, you've been a part of this, and you get to see so that's why people always get surprised, and I'm sure this happens to you too. Like they all get surprised about whenever I tell them that I've only been in this business for a year and a half, or however long it's been. But
and that's the thing.
Yeah, I love
just
that.
The fact I would have had no idea that you've only been in this business for a year and a half, because I feel like I've been reading your stuff for 5 years now. And it's the fact that you're always out there and you're always adding value and you're always communicating and you're consistent that people don't realize, whether it's been a year or 5 years or 10 years, they just know in their mind, this is somebody that I just inherently feel like I know and I like and I trust. And so that's going to open the door for them the next time they're looking to invest money to say, okay, I'm going to go talk to Tim because I just have this feeling like he's somebody worth talking to.
Yeah, I love that. And we're going to dig deeper into that, because you're totally right. We raised for 3 deals this past December, and a lot of the investors that came on those deals, well, guess who they were? They were people on this very show here.
Yep.
And so yeah, that's what Jay is sharing with you guys about, like sharing your process, even if you're new to this, but create a way to, whether you're documenting it through a website like he did, or you're doing a weekly webinar, like I'm doing, to bring people along, but somehow that you are educating, you providing education. In my case, I'm not the expert. I wasn't the expert on capital raising, so I brought on experts on capital raising. So you can do that as well, and you'll be surprised by building that community, building that goodwill, that trust. When it's time, when you have a deal to raise money, it's much easier. Like, it's mind-boggling to me, what I thought capital raising was versus what I now know what it is. Now that I have a deal, it's way easier when you have a community like what we're doing here. So let's talk about that. I know you have you have your podcast, you have your books, you have a lot of different things out there. Besides those education, is there any education or any platform that you go specifically targeting the passive investors for your syndication deals?
I don't. And it's funny because whenever people want me to talk about building a brand or capital raising, as if I know what I'm doing, I laugh because I don't. I'm just winging this. And my goal was never to build a brand. My goal was never to get known in the community. My goal was never to be able to raise money. And that all happened by accident. And I can go back and I can reverse engineer kind of some of the things I did. I'm not sure if I'd be able to do it again, but I can go back and look at what I did and realize that a lot of that worked. But even to this day, I'm not a sales guy. I'm not a marketing guy. I've never asked anybody for a penny. For me, raising money is all about building trust and building
Yep.
credibility and building a reputation, and then putting the opportunity out there and hoping that I've done a good enough job of the previous things that they're willing to talk to me about that deal. And I'm not one to talk to somebody and try and close them on the deal. I just put the opportunity out there. And if they're interested, if it's mutually beneficial, great. If it's not. And so for me, I don't consider myself great at what I do. It just happens to have worked because whatever I did has seemed to work. And what that is has just been consistency in message, consistency in brand. One of the things, and another tip out there that, again, if I reverse engineer all of this and I think about what worked and what didn't work, one of the things I've done a little bit differently than other people is one of my areas of expertise, I believe, is in economics. I have an MBA. I've always been tremendously interested in economics. I read a lot about economics. And so I write a lot about it. And there aren't a lot of people in this community that write a lot about economics. And so for me, it's given me an opportunity to stand out from the other 10,000 people that are out there on Facebook writing about how to live your life or raise money or politics or whatever it is. I've found a niche that really resonates with people, that fills a need. People always want to understand what's going on in economics and the economy better. And I've around that specific niche. And so for anybody out there, what I would say is everybody has some area of expertise. It doesn't have to be real estate. I like to think of it this way. If Warren Buffett were to come up to me today, and Warren Buffett doesn't do multifamily real estate, he doesn't buy real estate. But if Warren Buffett came up to me today and said, I'm doing a syndication, would you like to invest? I'm not going to say, you don't know anything about multifamily. No, I'm going to say, you're a successful investor. You have a proven track record over a long period of time. I can trust the fact that if you're getting into this business, you're probably have done your research and surrounded yourself with good people. And so what I'll tell anybody out there is be an expert in something, even if it's not real estate, because once somebody recognizes you as trustworthy and an expert in any area, when you then tell them that you're going to do real estate, the assumption, and you need to make sure that this is true, but the assumption is going to be, okay, I've recognized he was an expert in some area and he's built up trust and a reputation and credibility in that area. He wouldn't be going and moving into this area if he didn't do the same amount of research and due diligence and preparation. And so you'll get the benefit of the doubt. And so what I tell people is become an expert somewhere. And this is why professional athletes can often raise lots and lots of money. It's not because you trust professional athletes to be great business people necessarily, or to be great real estate people necessarily, but they're not people that go, oh my God, he was able to master that thing. I can't imagine he'd be getting into business or real estate if he didn't master that or couldn't master that as well. Whether or not that's true, again, that's up to you to prove it to that potential investor that you can, but it'll get them over the hurdle of coming and saying, hey, maybe I should talk to that person.
I love that. Yeah. And because some of you feel like you might not be an expert in any major topics right now, but you can always become an expert also. That's the other side to it.
Absolutely.
One of my partners in our Hero Wealth Fund, she's a CPA, but she's a corporate auditing type CPA, not a tax CPA. And so now, even though she doesn't have that tax background, but she's now learning everything there is about real estate taxes, like taxes around real estate investing. And to get herself to become an expert in that. So you can always train yourself to be an expert in any one particular topic. So that way, yeah. So if for whatever reason you feel like, hey, I don't have an expertise in any one area, well, you can choose and be an expert in a certain area.
And here's the thing: to be an expert, it means that you're smarter than most people. And with a month of research on any topic, I could probably be smart enough that I could start writing Facebook posts about it and educating other people. Doesn't mean I'm an expert yet, but I'm smarter than 90% of the people out there with a month of research. I start writing, and I write and I write and I research and I study and I learn, and I stay ahead of the 90 or 95 or 99% of the people that are reading my stuff. And eventually I'm going to be an expert. And as long as I stay ahead of the 95% of people that are reading my stuff, that's all that matters. They're still learning from me. I may not be a world-renowned expert, but they're learning from me. And over the course of a year or two or three, I'm actually becoming an expert, and I'm actually fulfilling that evolution.
Yeah, I love that. And if you guys don't yet see the theme here of, Jason's secret to success is being an expert in educating others, and sharing his knowledge with others, whether it's sharing even when it was just raw, here's what I'm doing today, each day on those flips, or sharing his, once he became an expert in those things, sharing the information. If you notice that trend of he's constantly out there sharing education, sharing knowledge, to an audience, to a community, and then the more he shares, the better he gets at that topic and becomes an expert in that, and people see him as an expert. And so, yeah, that when you have that level of expertise, like Jay was just saying, it makes it easier to raise money because you've added so much trust and so much goodwill. The know and trust factor, it's already there when you're educating someone. And so it makes it much easier for them to invest with you. I love that. Let's go into about your economic stuff and the market. I know you have your crystal ball of what's happening in the marketplace. So share with us, number one, what you're seeing this year in 2024, and then also share how far out are you seeing the trend?
I can almost see what happened yesterday. That's about how far out I'm willing to commit now. So look, nobody has any idea what's happening. You can listen to the 10 best economists in the world, and they're all going to disagree. I look at economics. I don't have a good analogy, but basically you make your best guesses. You use the data as much as you possibly can, and hopefully you're going to be right more times than most people. If you can be right more than 50% of the time, you're probably doing really well. It's like being a sports bettor. If you can win 52% of the time, you can make a living doing it. Most people can't do better than even. Some people can't even break even, 50-50. But so if you look at the data, a few things. One, keep in mind that economy and real estate, a lot of people like to conflate the two, and they assume if the economy is bad, real estate's going to be bad. If the economy is good, real estate's going to be good. Not necessarily the case. In fact, I think a lot of people have this thing called recency bias, where they remember 2008 as the last big recession. Obviously, 2020 was a recession, but it was a blip. And so if you're under 35 years old, basically the only recession you really remember is 2008. And a lot of people out there in this business are under 35 years old. And if that is the only recession that you remember in your lifetime, then every time you think of the word recession, you're going to equate it to what happened in 2008. And 2008 was a major recession, and real estate got crushed in 2008. In fact, real estate was the reason for the recession. But if you go back to the previous recession, 2001 or 1991 or 1989 or the early 80s or the four recessions in the 70s or the 60s, what you'll find is rarely do recessions have a big impact on residential real estate. Sometimes things flatten out. Sometimes, and if you look in the 70s, we saw several recessions in the 70s that were driven by inflation. What happened to real estate went through the roof in the 70s and early 80s. So don't assume even if I say I think there's going to be a recession, that necessarily means we're going to have a 2008 type real estate collapse. With that said, I think it is fairly obvious to a lot of people, and this is going to be my bet or guess as well. I think we're heading towards a recession. We still have this thing called a yield curve inversion, which I've talked about a good bit over the last couple of weeks, which is basically this thing that happens in the bond market when big investors, and when I say big investors, hedge funds, governments, billionaires start to get nervous about the economy. They start to move money around in treasury bonds a little bit differently than they normally do. And this causes this phenomenon called a yield curve inversion. And in pretty much every situation where we've had this yield curve inversion in the last 50 years, it's been followed by a recession between 6 and 24 months later. We're now 18 months into this yield curve inversion. It's the longest we've ever had this. And it's only 50 years worth of data. It's only 7 or 8 recessions worth of data. So maybe it's not a true correlation, but there's good reason to believe that because we have this yield curve inversion, that it's very likely that it's going to be followed by a recession. How big a recession? no idea. There's no correlation between how bad of a yield curve inversion and how bad of a recession. I think there's a lot of reason to believe it's not going to be a big recession, but I personally think that we're going to see a recession in 2024. We're going to see a softening in the jobs market. We're going to see people lose their jobs. I think there's going to be some good stuff that comes out of it. I think it'll drive inflation down, which I think everybody will be happy to hear. Inflation's lower than it was last year, but we saw a lot of compounding of price increases last year. A lot of people are still suffering, but I think that'll slow down. I think it'll give a chance, even though people lose jobs, I think we'll continue to see some wage growth. So those that have their jobs will be making more money and will be able to weather the inflation a little bit better. And then the real estate market, obviously prices have gone up tremendously over the last 3 years. If you look at the trend line for real estate values, from 1900 till 2013, what you'll find is that real estate tends to track inflation. And if you draw a graph of inflation since 2000 or since 1900 and real estate since 1900, all the way up until 2013, those trend lines, those two data points have converged. In 2013, real estate started to move up away from the trend line again, a good bit away from the trend line. And now real estate is valued much higher than what you would consider to be normal, given that inflation trend line over the last 120 years. And so a lot of people think that the obvious conclusion is we'll see what happened in 2008, which is real estate will basically collapse back to that trend line. Values will fall until we get back to that trend line. Could happen, but I think what's more likely to happen is that over the next 5 years, real estate values are going to stay flat while inflation, that trend line, catches up to real estate values. I think given supply and demand in the market, given where interest rates were, and given the fact that something like 80% of homeowners have mortgages that are under 4%, I think there's a good chance that we don't see values drop very much. But I do think it's likely that we will return to that trend line. And I think we'll do that by just seeing flat values over the next 5 years or so. In the multifamily real estate world, because I know a lot of people here are probably multifamily investors, we saw a 25 or 30% drop in values last year. Most of that was between March of last year and August of last year, 2 years ago, 2022, when interest rates started to go up. Since August of 2022 till now, we haven't really seen multifamily values drop very much. We haven't seen a lot of transaction volume. There hasn't been a lot of price discovery, but we just haven't seen a lot of price drop. So my take is that we're probably pretty close to the bottom. I think that over the next year, we're going to definitely see some distressed sales. There's still a lot of owners out there that are dealing with flow debt. They're dealing with rate cap. They're dealing with high interest rates, which are unlikely to go away anytime soon. So there are definitely going to be some distressed sales out there over the next year. But I think we're also going to start to see a lot more retail sales. And I think we're going to start to see values start to trend up over the next year. So I think there's going to be a recession, but I don't think real estate investors need to worry too much.
Gotcha. That's good. That's really good news. What about, especially on the multifamily side, we're so dependent on rent growth. How does that have a good correlation with the recession?
Rent growth tends, again, much like home values, to track inflation. And what we've seen is that trend, they've deviated. And rent growth over the last few years has deviated from the inflation trend line a good bit. And so I think we are likely to see the same thing in rent as we see in home values over the next couple of years. It's not as bad as home values. It hasn't deviated as much, but I think that over the next 2-3 years, we're likely to see below average, below mean rent increases in most markets. Doesn't mean negative rent increases. Literally, like, this country has never seen across the US for more than a couple months at a time, we've never seen a drop in rents in the last 150 years. So I don't think now is going to be the first time that happens, but I do think we're going to see slower than mean or slower than average growth over the next couple years. So if you're getting ready to do a syndication or a multifamily deal, I wouldn't be modeling 4% rent growth over the next couple of years. I wouldn't be modeling 3% rent growth. I'd basically be taking whatever the historical average is in your market, subtracting a little bit from that for the next year or two, and then moving back up to whatever the historical average is in your market. Likewise, on the expense side, I think inflation is definitely moving down towards the historic average of about 2.5%. But right now it's still above that. So if you're buying multifamily right now, don't model your 2% expense growth every year that we have hammered into our models. Model 3%, even 4% in some areas. And certainly don't model insurance and property tax growth at the same rate that you model your operating expense, your other operating expense growth. Because in a lot of markets, we're seeing insurance go through the roof. We're seeing property taxes start to catch up with values. A lot of markets don't reset their property taxes every year or every time a property sells. So we're starting to see that catch up. So make sure you're conservative in your underwriting and know that things are likely to get better over the next couple of years, but that doesn't mean that this year and next year are going to be great years.
That's really good. Yeah. And not only being conservative on your own underwriting, but yeah, when you're looking at other deals, whether you're investing as LP or you're coming on as like participating in that deal somehow, take a look at how the operator is also underwriting. Yeah, it's so interesting how, the last few years, everybody was underwriting at crazy rent growth. We were looking at my team, just looking at a deal this past week where they're projecting, I forgot what the normal rent is. I think it's around $1,000 or something like that, but they're projecting only a $50 rent growth for the next 5 years. Like, wow, that's good. That's a conservative approach to that. But
here's something worth thinking about. And my partner, Ashley, has talked about this a whole lot. So she gets credit for this, not me. Basically, when you sell a property, there's two numbers that factor into the sale of that property. There's the NOI and there's the cap rate. And over the last several years, syndicators have basically forecasted their exit NOI and their exit cap rate to figure out what they can sell their properties for and hopefully make money. And up until last year, for several years prior, what we saw was that operators were selling for a lot higher than they expected. And a lot of those operators were patting themselves on the back for doing such a great job with the assumption that they hit their NOI and their cap rate targets. And that's the reason why they were able to sell for so much higher than what they projected. In reality, if you go back and look at a lot of those deals, and I haven't looked at a lot of those deals, but I've looked at a number of them and I've talked to a number of the operators that I invest with. And what we found is that most of those operators actually missed their NOI between 2018 and 2022. They didn't achieve the NOI that they pro forma'd, but because cap rates compressed so much, they were still able to make a whole lot more money than they expected. And so that begs the question, what happens in the next 5 years when cap rates do exactly what operators expect, but they're missing their NOIs? So what I want to see is operators that are very conservative on their NOI, because if you look back the last 5 years, most of them have missed it. And if cap rates aren't compressing enough to save them, you're going to see a lot of operators that aren't making the money that they thought they were going to make on exit.
Good. Such a good point. I'm curious, you have tons of knowledge. Why do you choose to do less deals versus like blowing it up, doing a lot more deals?
I will do more deals with my own cash. I don't mind my own financial life to be a portfolio play, knowing that some deals will do well, some deals will do poorly, most will make money on, but some will lose money on, maybe some will lose a lot of money on. I'm an angel investor. I invest in businesses. So I'm used to losing 100% of my money on 70% of my deals, knowing that I'm going to make a lot more on the other 30% of the deals. That's me personally. And that's a risk tolerance. That's a diversification that I can control. And that's a risk tolerance that I'm comfortable with. My investors don't have the ability to diversify through me in the same way. If somebody invests in one deal of mine, they don't want me to be taking even enough risk where 1 out of 10 fails. Because if they're unlucky enough to be one of that 1 out of 10, they've now lost money. And so for me, again, when I have investors involved, it's not a portfolio play for me. Every deal has to stand on its own. Every deal has to be good enough that I'm willing to say, if this was the only deal I could put my capital into, I'd be comfortable putting my capital into it, because I have a lot of investors where that's the case. That's the only deal they're investing in. And so they need to know that they can be comfortable that it's not just a portfolio play.
I like that. And I'd love to see a war too. And hopefully I'm one of the guys that will popularize, I don't know if that's the right word, but making it a more commonplace that investors invest in a fund and not just doing syndications where, they can live and die by one deal.
Absolutely.
Versus in the fund, they can have that, take advantage of that diversifications. And yeah, so like you said, worst case scenario, 7 of them goes bad, but 3 home runs out of that 10, you're still ahead.
Yep.
I love that. All right. On the economy side, what are some of the resources, education that you recommend that we become familiar with, kind of stay on top of it, other than, of course, following your newsletter and your updates and you're on that topic?
Definitely check out my newsletter. I'll give you the link later. But this is what I tell people. If you go and you just do a Google search for economic calendar, or maybe economic calendar market watch, you'll find several sites, CNBC, Market Watch, that basically they have this calendar of all the data that's coming out in the next week or 2 weeks or whatever it is. And they say, this is what the consensus is that the expert expects that data to be, and this is what the data ends up being. And so every day, go to that calendar and see what data was released. And so maybe one day you wake up and, oh, okay, it's jobs data was released today. And click on the jobs data and read the report from the Bureau of Labor Statistics about that jobs report. And as you're reading that, you're going to be like, oh my God, there's a term. I have no idea what this term means. Go do a search for that term. Look up that term. That's going to lead you to 10 more terms. And you're like, I don't know what that means. And go do a search for those terms. And then come back to the report and keep reading and spend an hour or two reading that jobs report that you've never read before, doing Google searches for all the terms you don't understand. That's going to send you down a rabbit hole that's going to force you to understand other things and other things. And 2 hours later, you're going to come back and you're going to be like, okay, I've got a general idea of what this jobs report is telling me, what it's not telling me, what it means, what it's good for, what it's not good for, and then move on to the next report. And before you know how to think about all of this data, you start to read commentary from experts about why does this jobs data and this GDP data together mean X, Y, or Z? Or why does an inverted yield curve? Why does that mean this, that, or the other? Whatever it is, just start reading these reports. And anytime you don't understand something, look it up. And anytime you don't understand something when you're looking it up, look that up. And eventually you're going to learn all of this stuff. All you need is some catalyst to start looking things up. And the best place to start is with the raw data.
I like that. I love that way of digging deeper. And then, when you learning like that, where you're taking information, you're putting it into practice, doing that research helps you to learn it faster and retain it faster, retain it more also too. So I love that. All right, Jay, what's other, just not necessarily about the economy, but what are the tools that you use in your business that you really like that, you want to share with the group here?
I'm not a huge tool guy, which is crazy. I spent a decade at Microsoft building products, and yet I hate technology because I feel like I spend so much time dealing with like technology from a meta level that it's taking more time than it's saving me. But that said, there are definitely a few things just from an organization standpoint. A great CRM. It doesn't matter what you use. I use a CRM called Go High Level, which I absolutely love, but everybody needs a good CRM. I've seen too many people that kind of handle their mailing list or their investor list in a spreadsheet or in MailChimp, and there are too many things you can't do. Like I use my CRM basically to see where every one of my investors is in my pipeline, and I try and push them through. So for example, one of the things we do in our CRM is we have several thousand people. And most of them, when they sign up, they say they don't know if they're accredited. We ask all of our potential investors or anybody that signs up for my newsletter, I say, are you accredited? Because I want to know if they can do our 506Cs or if they can't. 3/4 of people don't know if they're accredited. And so I have this automatic every 2 months survey that goes out that basically says, hey, would you like to find out if you're accredited? Take our quiz. And if they say yes, it goes in, it asks them 4 questions. Are you married? What's your income? What's your net worth? How much is your house leveraged? And that can tell them if they're accredited or not. If it turns out they are, our database is now automatically updated with the fact that they are accredited, even though they didn't know. Now they know, now we know, and they move along in the pipeline. Next piece of the pipeline is I can send them a survey saying, hey, are you interested in investing in a syndication or passively investing? If so, would you be interested in multifamily or self-storage or this or that? And if they say yes, I can move them along in the pipeline. If they say no, I can add them to another email where I say, hey, why aren't you interested in investing in passive deals? Do you not know enough? Blah, blah, blah. I figure out the reason. I can add them to another pipeline. And so a good CRM will really allow you to track all of your potential investors, figure out what they're thinking, what they want to invest in, how much they want to invest. I think too many operators basically going with the attitude of this is what I'm going to buy this year. And then I'll go out and I'll find the investors to buy that type of deal. Assuming you have the expertise. Obviously, don't do this if you don't understand the asset class, but I prefer to go out the other way. I like to see what types of deals my investors are interested in. Are they interested in stuff in Texas or maybe not anymore? Are they interested in stuff in the Southeast? Maybe yes, maybe no. Are they looking for value add or stabilized or new development? Are they looking for multifamily or self-storage or industrial? Are they looking for stuff that's going to pay cash flow or back-end profits or tax benefits? And when I know exactly what my investors are looking for, if I go out and find that type of deal, it's going to be a whole lot easier for me to raise capital than if I just find the deal that I want to find and then say, okay, now I need to figure out which investors this is right for.
I love
so I'm
that.
sorry. And so that was the first piece. So CRM is the first piece. Second piece is, and I'm going to plug Adrian here, but a great investor portal. And I highly recommend Cashflow Portal. But basically, it's your opportunity to manage your deal, to manage your cap table, to manage basically everything that has to do with your investors after they invest with you. And a great platform is going to have is going to give you the opportunity to parse the data in all different sorts of ways, which is allow you, it's the age old adage of your best future customers are going to be your current customers. There's a high cost of acquisition for a new investor. So you want your current investors to be happy and to invest again. And a great portal is basically going to give you the data you need to determine are your investors happy and what you need to give them to keep them happy. So certainly a great investor portal. And then I'm not on the asset management side, so I can't speak to that, but I imagine it's probably most important to have some great tools on the asset management side as well. But for me, CRM and a great investor portal are the two big things in my life that I care about from a tool standpoint.
I love that. Thank you so much for sharing that. So Jay, the folks wants to connect with you, reach out to you, partner with you, invest with you, learn from you. Where would you like to send them?
Yeah, go to jscott, just the letter J, SCOTT.com. That's my link tree. And if from there you can sign up for my newsletter, mailing list, or check out our podcast or anything.
Perfect. Jay, thank you so much for doing this interview with me. You have been such a wealth amount of knowledge. You always love learning from you. Always love. I follow your updates on the market quite a bit. Always loving that. Thank you so much again for sharing your knowledge and wisdom with us today.
Thanks, Tim. I appreciate being here, and thanks everybody for hanging out.
All righty.